Over the last 2 decades, China has been forging a strong alliance with Africa. Chinese foreign direct investment in the continent between 2003 and 2020 rose by a multiple of 56 times to $4.23 billion in the year. American FDI was only half that. Furthermore, in recent years, trade between China and Africa has risen exponentially, whilst US-African trade growth has paled in comparison. But why is China increasingly trading and investing in Africa? To see the development of the Sino-African relationship, it's important to look at China's recent political history. Between 1945 and 1949, the Chinese Civil War rumbled on between two political parties. The Kuomintang, a nationalist party with democratic and capitalist values at its core, and the Chinese Communist Party, a party with communist and socialist values at its core. The CCP emerged victorious, and on the 1st of October 1949, its leader, Mao Zedong, proclaimed the establishment of the People's Republic of China. The KMT fled to Taiwan, where it continued to rule as the Republic of China. Both countries still claim to be the rightful governments of all Chinese territory. Today, the PRC maintains that Taiwan is a province within its territory. This is known as the One China policy. In 1971, the United Nations General Assembly Resolution 2758 was passed, recognising the PRC as the only legitimate representative of China to the United Nations. Consequently, Taiwan had its UN representation removed. 62% of Africa voted in support, and whilst African countries had diplomatic and economic ties to China at this time, they were not to the extent of those at the present day. Fast forward to voting in 2022 on Resolution ES 11.1, and a different picture emerges. The resolution addressed Russia's invasion of Ukraine and demanded Russia's immediate withdrawal of troops from Ukraine's sovereign territory. Unsurprisingly, Russia's main ally, China, abstained from the vote. However, when you break down the voting, Africa's increased alignment with China and decreasing alignment with the West becomes apparent. Only 51% of African nations supported the resolution. This is in stark contrast to the 81% of remaining nations. Furthermore, just under half of all abstentions were African nations. Representatives of African nations cited political non-alignment and not wanting to become involved in a faraway conflict. However, this speaks more to China's sphere of influence within the region. You see, African nations voting in the UN and foreign policy may have been impacted by the Belt and Road Initiative. This was announced by President Xi Jinping in 2013 with an ambitious aim: finance and invest billions into building a vast network of transportation and communication infrastructure, including roads, railways, ports, and airports that will connect China with other countries in Asia, Europe, Africa, and beyond. This initiative addresses some of China's largest challenges, including overcapacity in its manufacturing sector, the need to find new markets for its goods and services, and a desire to promote its political and economic influence on the global stage, thus cementing the nation as a global powerhouse. Examples of successfully completed projects so far include Kenya's Mombasa to Nairobi standard gauge railway, Cameroon's Kribi deep sea port, and a new solar power station in Morocco. Beijing's only condition is that the country supports the One China policy. The majority of loans are provided by state-owned banks, such as the China Development Bank and Export-Import Bank of China. This option is easier than borrowing from the International Monetary Fund. The IMF aims to facilitate sustainable growth and heavily scrutinises a country based on factors such as its human rights record, corruption levels, and debt stress. It may even require a country to implement legislative change to meet criteria and access funding. Thus, China's seemingly simpler terms are favoured. One of the African countries that has been in receipt of some of the most Chinese financing is Angola. Angola is sometimes referred to as the Kuwait of Africa due to it having the third largest reserves of oil on the continent. In 2020, it was China's fourth largest supplier of the natural resource, accounting for about 10% of its imports, and China's second largest trading partner in Africa. Only Russia, Saudi Arabia, and Iraq exported more oil to Beijing. Therefore, it comes at no surprise that China has provided an estimated $43 billion in loans to Angola between 2000 and 2019. One of the projects China financed was the reconstruction of the Benguela Railway. The project lasted 8 years and achieved completion in 2014. The railway is a critical transport link that connects Angola's Atlantic coast with the oil-rich regions in the east and northeast. It also connects the country to its neighbours, the Democratic Republic of Congo and Zambia. The reliable and efficient transport route is of massive benefit to the Angolan people. Furthermore, the increased export capacity of the ports it connects, Luanda, Lobito and Soy, have helped increase oil, other natural resource and agricultural product exports. The benefits to China financing the project are simple. The railway supports efficient and cost-effective transportation of oil that it imports, political ties with the Angolan government strengthen, and the consortium of Chinese partially state-owned companies involved in the reconstruction generate a profit. In 2022, a third of China's $14.72 trillion GDP was generated by its industrial sector. This strategic $1.8 billion loan from China's Exim Bank could provide real value to the Chinese domestic economy. Another country that is an important trading partner of China and receives a lot of infrastructure funding is the Democratic Republic of Congo. Untapped mineral deposits including copper, cobalt, lithium, gold, diamonds and others are valued at $24 trillion. This makes the DRC one of the richest countries in terms of natural resource wealth. Despite this, it is one of the poorest countries in the world in terms of GDP per capita. The country has experienced decades of conflict and political instability, which has hampered its economic development. In 2007, it signed an infrastructure for minerals deal with Chinese investors. Chinese state-owned firms Sino Hydro Corp and China Railway Group Limited promised $9 billion in investment over 10 years to develop critical infrastructure, such as hospitals, schools, railways, and roads. The loan was secured by some of the DRC's assets, such as land, mines, and minerals to be mined in the future. This is referred to as a resource-backed loan. Some projects that came to fruition using the investment include the Sino-Congolese Friendship Hospital, completed in 2016, the National Fibre Optic Backbone Project, also completed in 2016, and the Karavia Bridge, completed in 2015. On the face of it, this deal demonstrates China's commitment to helping the low-income country develop. However, deals like this are also very opaque. Details within the contracts are largely unknown and raise concerns over exploitation. This all feeds into a concept known as debt trap diplomacy. This is when a creditor extends debt to a borrowing nation partially or solely to increase the lender's political leverage. When global commodity prices dropped in 2020, the vulnerability of these RBLs became very apparent. The DRC nearly defaulted on its loan repayments. After negotiations with the Chinese government, they secured a further 6 months to pay $152 million in interest on its debt. In the event of default, China would have technically been able to seize land, mines, and minerals to cover the debt owed by the DRC. However, it's important to note that China does not seize land as a form of debt repayment. If countries struggle to make debt repayments, the Chinese government will restructure the debt and in some instances provide debt relief. China doesn't just provide loans to Africa, state-owned enterprises and privately owned enterprises invest too. This is referred to as FDI. Chinese textile companies have moved some of their operations to countries such as Ethiopia and Kenya that invest in building and upgrading existing textile factories. This creates jobs during and after the construction phase and increases the government's tax base. These companies are attracted by the low-cost labour force and growing consumer market. Chinese companies have also forayed into the African real estate industry through the construction of mixed-use developments and commercial and residential real estate projects. However, the majority of investment still remains in the mining industry, particularly in cobalt mines, with 15 out of 19 cobalt producing mines in the country owned by the Chinese. Tenke Fungurume Mine, the Ziwa Mine, Misonoi Mine, and the Kamoa-Kakula Copper Project are just a few mines who have majority Chinese ownership. The Tenke Fungurume Mine is an important case study for all the benefits and challenges that come with foreign investment. The mine is of massive strategic importance as it is one of the world's largest cobalt mines. The ownership is split 80-20 between Chinese state-owned CMOC and Congolese reshaping. The mine provides 8,000 Congolese citizens with work and generates revenue for the government through taxes and royalties. However, it has not been without an array of controversies. Environmental concerns have been raised due to deforestation and pollution of local water sources, reported human rights violations in the form of poor working conditions and potential use of child labour, owners bribing government officials to secure mining permits, and most recently, allegations from the Congolese minority owners that the Chinese owners have underreported the mineral reserves in order to avoid paying $5 billion in royalties to them are just some of the controversies to mention. Unfortunately, these problems aren't just unique to this mine or the mining industry. However, the main concern about foreign investment in the African mining industry is that Africa has less control of its own resources. Independent miners in the DRC reportedly sell their highest quality cobalt ore, mainly to Chinese buyers, at $7,000 a tonne. At the time of recording, cobalt trades for just over $35,000 a tonne, whilst in March 2018, prices reached just over $95,000 a tonne. Whilst the ore has to be exported back to China for refining, the profit margin is very significant, raising the question whether the DRC and its African counterparts barely value their resources. This has led to some Western media outlets to accuse China of engaging in neo-colonialism. It remains to be seen if the opacity of these deals come back to bite these nations in the future. Ultimately, China's only obligation when investing abroad is to do what is needed to support its 1.4 billion population. This can take many forms, including forging political ties, generating return on investment, or securing access to natural resources to support its domestic economic activity. The deal made with the DRC was extremely prudent, as since 2007, the demand for electric vehicles has risen exponentially. In 2021, China had 50% of the EV market share. The infrastructure for minerals deal secured access to key components of EV batteries like lithium and cobalt. In 2022, an estimated 70% of the mined cobalt supply came from the DRC. This is extremely clever geopolitics from the Chinese and raises concerns over the monopolization of the cobalt market. Chinese company BYD has since become one of the largest EV manufacturers in the world. Without the Belt and Road Initiative, would this have been possible?